So this week, I am going to touch on an article that I authored on basically a tale of two small cap M&A stock strategies, comparing two companies. One would be Firan Technologies, FTG on the TSX, and Simply Solventless or Hash on the TSX Venture, juxtaposing the two. It's a summary here. They juxtapose the responsible acquisition strategy of Firan with the more recent aggressive dilutive approach from Simply Solventless Concentrates, illustrating how their respective paths have impacted shareholder returns. And we have interviewed both of these management teams once for Hash about I don't know, 20, 25 times for Firan. One we have recommended and owned for about a decade. The other we took a hard pass on. This will be part one. I'm going to look at more Firan today. Give some general thoughts to start on the small and microcap M&A strategies that we see in the market, aggressive versus measured. Businesses that use M&A as their primary growth driver, we believe, walk a fine line. For every massive success story like the Boyd Group's, a serial acquirer of auto body repair shops recommended by Keystone in 2008 at $2.30, it trades above $200. So a success story. There are 10, say, Dye & Durham's or Lightspeeds, decent businesses that execute poorly on aggressive growth by acquisition strategies. There are also countless roll-up stories that never even get out of the starting gate and end up destroying investor capital. Unfortunately, the microcap market is littered with failed or failing M&A strategies, including a recent example that we will have in part two and touch on that next week is Simply Solventless Concentrates. The company provides an excellent foil for the more measured and successful M&A strategy of Firan Technology Corporation, FTG on the TSX. So the strategy of growth by acquisition can be a powerful accelerant for a company's expansion, but its success hinges critically on execution and financial prudence. While an aggressive debt-funded or fueled and highly dilutive approach can lead to rapid scale, it often comes with significant integration challenges and shareholder value destruction. Conversely, a measured, responsible strategy often characterized by strategic debt utilization, minimal shareholder dilution, tends to yield more sustainable and rewarding long-term gains. Let's look at growth by acquisition in reality. Well, sexy in theory, growth by acquisition can be a risky strategy with many high-profile examples of mergers and acquisitions failing, often spectacularly. The reality is a significant number of acquisitions fail to meet expectations, with estimates ranging between 70 and 90%. That is quite a shocking figure, but it is from studies that show that most acquisitions don't even meet the initial expectations. Common reasons for failures include poor integration, overpaying for the target company, overestimated synergies, we see that a lot, cultural clashes, and a lack of strategic alignment. Now, what is Keystone's preferred growth strategy? We look for a mix of measured M&A funded by cash flow, cash on hand, or reasonable debt, always with an eye towards continued organic growth within the company's existing operations. That is the most profitable growth for these businesses. As an example from Keystone's small cap Canadian research of an effective M&A strategy, we enter Firan Technology Corporation's FTG on the TSX. The business of this company, a North American manufacturer of high technology printed circuit boards and illuminated cockpit products for aerospace and defense. Its M&A strategy has been disciplined and accretive growth by acquisition model. FTG has pursued an opportunistic and measured M&A strategy to expand its capabilities, customer base, and market reach, all while maintaining a strong balance sheet, that's important, and prioritizing shareholder value through minimal equity dilution. So let's say FTG's approach often involves looking for strategic fits, acquiring companies that complement existing operations, technology, or market segments. They look for reasonable debt levels, cash on hand. They maintain that while making these acquisitions. It avoids diluting existing shareholders by issuing new shares. Effective integration. They are focused on integrating and acquiring businesses to realize synergies and optimize operations with an eye to growing those businesses that they acquire organically. Let's look at their timeline, their M&A strategy over the last 10 years. We go back to 2016 to start this off. Photo Etch was a company they acquired there. They acquired it to expand the customer base and product offerings. They successfully transitioned operations into an existing facility, closing the Photo Etch site. So they bought their customers. Teledyne, PCT, similar to the Photo Etch, this acquisition aimed to expand product lines with operations moving into FTG's Chatsworth facility. Now, in 2022, 2023, following the global shutdown of travel and the pandemic, huge hit to aerospace. The business responsibly played defense, built a strong net cash position, and just ahead of loosening of global restrictions, the company played offense, buying two businesses primarily with cash on hand. Those two businesses here, IMI Inc. and Holiday Circuits, was the big acquisition, added U.S. manufacturing capacity for RF and high technology products for aerospace and defense. Combined sales of these two businesses, primarily the sales came from Holiday, pre-pandemic, were about $45 million. So sizable acquisitions. In Q1 of this year, the company completed on Flight Aerospace a significant acquisition, enhancing FTG's presence in the commercial aerospace aftermarket and expanding product offerings, particularly on Airbus aircraft. The deal reinforces FTG's commitment to strategic accretive growth in its core segments. Through these acquisitions, FTG has demonstrated a commitment to managing its debt effectively. For example, in Q1 2025 results, even after all these acquisitions, the Flight acquisitions, which just came in, FTG reported a healthy net debt of only $8.3 million. The company's consistent generation of strong operating cash flow has been instrumental in its ability to take on debt for strategic growth and then deleverage. Let's look at their minimal shareholder dilution over time. A hallmark of FTG's responsible growth strategy is its commitment to limiting shareholder dilution. Over the past decade, despite multiple acquisitions we saw there, the company has largely avoided significant share issuances to fund these deals. So the weighted average number of shares when it started this deals, Photo Etch and Teledyne, 2026, about 24 million shares. Post-acquisition, about 24.9. That's post the Flight acquisition. This represents an increase of less than 4% of shares outstanding over nearly a decade of significant growth, multiple acquisitions, demonstrating remarkable financial discipline and a strong focus on enhancing per share value. It's not surprising over that period. This is even just over the past 5 years. But since our recommendation at about $1.35, the stock is up well over 700%. But you can just see it's up just under 600% in the past 5 years. Next week, I'm going to touch on the foil for Firan Technologies. That would be Simply Solventless Hash. So stay tuned for that. There's our disclosures.
I hate to say it, but I think I'm looking more forward to next week. I mean, obviously, I'm familiar with Firan, and it's been a tremendous success story, but I'm looking forward to you ripping on Simply Solventless.
Yeah, and it's not necessarily just ripping on the company. It's just showing one strategy versus the other strategy and which is more successful over the short and long term. And, proof is in the results. That's what we always say. With Firan Technology, basic, boring business, but those results to me are sexy. Hash may have been a sexy business, but we'll see, the results have not been sexy.
Ryan just likes cash.
I also like saying sexy a lot, apparently.
A little greedy that way, but
yeah, it's true.
Good in this line.
Cash or hash? I'm not sure. As long if you said hash, that would be different.
Yeah, it's legal.
Yeah, it's true.
I said cash, but you're allowed to like hash as well.
It's true. It's true.
Just not the stock.
No, no, no. I mean, and again, nothing against the business. It's just the execution in terms of the acquisition strategy. Very aggressive, short term, and we'll talk about that next week.